If you look closely at the surface of the Indian stock market right now, it appears surprisingly calm. For a domestic investor measuring their wealth in rupees, the Nifty index has been mostly flat since the start of 2025. You put money in, and it hovers around the same mark. This chart shows a different reality for foreign investors. Because the rupee has fallen against the dollar, global capital is bleeding. Look at the top row. A 9.1% currency drop means international funds are actually eating a 9.5% loss. When the underlying currency loses that much ground, the stability of the local market doesn't matter. Real returns for these international investors are measured in dollars, making the broad Indian market a losing bet at the moment. So if billions of dollars are bleeding out of India, where are fund managers sending that capital? This data shows exactly where that money is landing. Over in East Asia, South Korea has delivered a 175% return to dollar investors, and Taiwan is up nearly 76%. Yet, foreign capital hasn't completely vanished from India. A closer look reveals that fund managers have simply stopped buying the broad index and started hunting for very specific targets. This shareholding graph shows exactly where the remaining foreign capital is concentrated. Semmon Capital, on the far left, saw a 21% increase in FII holdings following a total business restructuring led by Abu Dhabi's sovereign-backed international holding company. We see similar microbuys further down the list. Shri Ram Finance is drawing capital by capitalizing on strong rural lending, while KS SmartTech, a former paper company, is attracting foreign dollars after successfully pivoting into Internet of Things infrastructure. Broad, sector-wide confidence is gone. The foreign money remaining in India is strictly reserved for high-conviction individual turnaround stories. But there is a massive counterweight absorbing all that foreign selling: India's domestic mutual funds. These local fund managers operate under entirely different rules. They can't pack up and buy Taiwanese semiconductor stocks. Their capital has to be deployed locally, and right now, they have immense purchasing power. Every month, retail investors pour billions into systematic investment plans, providing a relentless, steady stream of cash. When foreign funds dump heavily weighted blue-chip banks, local managers view it as an opportunity to pick up these stable companies at a severe discount. The market is caught in a strict tug-of-war. Global logic dictates that heavyweights must be sold for better yields abroad, while local logic drives managers to buy those exact same companies while they're cheap. So if these two groups are operating on entirely different playbooks, are there any investments they actually agree on? This bar chart answers that question. Out of the entire universe of mid to large cap stocks, exactly 3 companies managed to attract fresh money from both foreign and domestic funds at the same time. Mark Sands Pharma earned its spot by keeping debt low and securing high FDA approval rates as it shifted toward high-margin medications in the US and UK markets. Then there's Vishal Mega Mart. It operates highly efficiently in Tier 2 and Tier 3 cities, successfully converting the lower middle-class demographic into strong, consistent profit growth, a rare feat in retail. Finally, Natco Pharma used the massive cash reserves it built up from selling generic cancer drugs in the US to buy highly profitable operations in other emerging markets. The era of foreign capital passively lifting the entire Indian market is suspended for now. Success in this environment requires choosing a side. You either rely on local value-buying strategies to weather the storm, or you meticulously hunt for those rare, hyper-efficient outliers that command global respect no matter the macro conditions.